In terms of the tutorial for today, I was thinking of talking about currency forecast valuations, exchange rate determination, so FX valuations, because one of the previous tutorials I gave was on some of the nuts and bolts of FX markets, spot, forward, and carry. And so kind of an extension of that is valuations. How do you value currencies? So I'll talk a bit about that, and I'll give some kind of examples as well. But in essence, the challenge with currencies is that unlike other markets, like if you have a bond, you have the coupon or the interest on the bond, and then you can kind of work out the value of a bond by just the series of interest rates you get and the principal you get paid back. So there's something for you to hold on to there to work out the valuation. Same with equities as well. So with equities, a company pays dividends and you can work out, okay, the company gives a stream of dividends over the next 30, 40 years, and I can work out the present value of those dividends and work out the value of the company. Now for currencies, it's more difficult because currencies are sort of a long short market. You know, you have the pound, you know, and the dollar, you know, so what should the right value be? So the sort of the foundational currency valuation theory is called PPP, or purchasing power parity theory, which is based on the idea of the law of one price, which is to say that if you have identical goods in two different countries, when you adjust for the currency, the price of the goods should be the same. So I'll give you an example of that. If I share my screen. There you go. Okay, so let me take an example of, say, the iPhone. So ideally, you want a good that's identical between countries. So if I take, okay, so what I'll do is I will go to the UK. So iPhone 12. So I'll buy iPhone 12, 6.1 inch screen, 128 gig, no trade-in. So you pay £849 for that iPhone. So what I'll do is I'll say, okay, iPhone 12, 6.1 inch, 128 gig. And then that is £849. So now let me see what the price in the US is for the same product. So if I flip to the US store, so let me just quickly work out how to switch. Let me just do that then. Apple US. Okay, yeah. So this is the US site. So I will now buy the iPhone 12 in the US. Okay, so we're going to go for the iPhone 12, 6.1 inch, white, the SIM-free one, 128 gig. We're not going to do a trade-in. It's 879 US dollars. So that's 879 US dollars. So the implied kind of PPP FX rate turns out to be 1.0355. So that means, and then if I look at the current exchange rate, the current exchange rate for cable is 1.362. So the current rate is 1.362, which means according to this, the pound is overvalued by 30%. And the reason you know that is that means that if I was to buy an iPhone in the US, I would pay 879 US dollars. If I then sold it in the UK, I would basically I would divide that. So in pound terms, I could sell it. I buy it in the US for $879. I convert it into pounds. So in today's pounds term, I'm actually paying £646, and I can now sell it in the UK and make a. I can now make a £200 profit by doing that. So that tells you the pound is too expensive. So the pound has to weaken to a level where if the pound weakened to 103, then the price would be exactly the same as the UK. So this is the law of one price, basically. So you have two identical goods. When you do the currency exchange rate, you'll find out which currency is expensive, which is cheap. And if in this case, as you see, the pound's expensive, in theory, what should happen is that somebody just should start to buy iPhones in the US in massive size, and they should start to sell the dollar, or sell the dollar and buy pounds, or the other way around, and start to sell it in the UK, then receive the dollars back. So what would end up happening is that there'll be lots of dollar buying that would happen, because everybody would be going to the US to buy the iPhone. So they'll be buying dollars. In the UK, they'll be leaving the UK, converting their pounds to US dollars. So people will start to fly to New York and take advantage of the fact that the currency is so expensive and start buying everything in the US. And then in theory, if that's large enough, the pound should start to weaken and you end up going back towards PPP. So is that kind of roughly clear, what I've just described there? Now, there are some caveats here because there's different tax rates between the countries. So some of this difference, where it says it's 30% overvalued, some of that may actually just be different tax rates. So VAT in the UK is 20%, VAT in New York is 8%. So that's 12% differential is just explained by sales tax, which you can't arbitrage in this way. So there may be some adjustments like that. But in general, you find that if according to PPP, a currency is very expensive, people in the expensive country have an incentive to go to holiday in the cheaper country and just buy everything up in that country, then come back. So, and in theory, the flow should kind of occur in that way. So how do you map this onto currencies in a kind of, as an economist or strategist? What we can do is, I'm going to use Bloomberg now to download a series of cable, so GBP cable, and I'm going to create a inflation adjusted exchange rate, which is kind of a way of looking at PPP over the long run. So hang on, which date did I start? So let's start from, say, 1990. So I'm going to just download a time series here. So this is when I draw this chart here. So I've just downloaded this data from Bloomberg. This is a chart of cable or pound against the US dollar. Remember in the previous tutorial, I talk about how cable refers to the cable under the water between the UK and the US. So this tells you how the exchange rate has evolved in nominal terms. So this is just the market quotation. So at one point, just in 2007, the pound could buy $2 US. So the pound is very expensive. More recently, it's obviously fallen a lot in recent years. So this is the nominal exchange rate. So how do we start to think about PPP? Well, what we have to do is we have to download price series for the US and for the UK, and then we can convert the exchange rate to real exchange rates, so inflation adjusted exchange rates, and that will allow us to start to create a PPP series for cable. So what I'm going to do is I'm going to find the currency code on Bloomberg for US inflation and for UK inflation. So the price series is just CPI data for the different countries. So let me just pull up. So this is my Bloomberg. So ECST is on Bloomberg, takes you to the country's economic data series. I'm going to go to prices, consumer prices. Just wait for this to load. Over here, I want to look at index because I just want the level of prices, not the changes. And this is the code for, so that's the code for inflation in the US. So I'm going to just drag that over here. I'm going to just write that down, US CPI. And then I'm going to do the same for the UK. So United Kingdom, price series, I'm going to go to levels. Now the UK has different price series, CPI and RPI. I prefer to use CPI, which is more of a standardized way of looking at inflation. So here's the, there's the code. So I'm going to just drag that over here. So that's UK CPI. Now I'm going to just download the series on Bloomberg. So let me just quickly just don't think about what I'm doing here. I'm just kind of doing the quick way to download the series. Okay, so that's price there. So I've got the US price series, the UK price series here, and this should be dates. So now to create the real exchange rates, what I do is it's the nominal exchange rate. So this is the exchange rate that you normally have quoted in the market. You multiply it by inflation, CPI in the UK, and you divide it by inflation in the US. And the intuition there is that a currency's value will go up if the inflation in that country goes up. That real exchange rate is going up over time. That means that country can buy more stuff compared to before. You know, if their prices go up, then the real exchange rate is going up. So that's why you multiply it by the UK first, because it's cable. So cable goes up, the pound's getting stronger. Inflation goes up, the pound also gets stronger. And you divide it by US, which would have the inverse relationship. So it's just the ratio of the two. So now I'll just add that into my chart. And let me just reset that. And so I'll just bring it over here. And let me put that on secondary axis. And see, what you can see here is that they look very similar, both lines. So they have, don't worry about the scales, it's 0.7 and things like that, just because we're using the CPIs of different countries, which have their different units. But you can see they roughly follow each other very closely. So what that tells you is that the UK inflation and US inflation have kind of moved together over time. So when you compare rich countries to each other, they normally tend to have similar kind of inflation paths. But if you go further back, so I went back to 1990. So 1990 onwards has been a period where inflation has been quite low in the rich countries. So you won't see so much differences between nominal exchange rates and real exchange rates. But if we went back to the 1970s, then you would see much bigger differences. So it looks like the UK doesn't have data going that far back for that measure. So I'm going to switch to a different measure for UK inflation, to RPI, which is just an older measure of inflation that's used in the UK. Yeah. Okay, so we just have a problem here because we're getting different dates for, actually what I will do is I'll do it for 1975. See if they, so I just need to check what dates I have for when everything starts. So you say UK CPI starting from 87, so it's not allowing me to, let me try another series. Let's see so this is a common problem you find. The data doesn't go far back enough. So this goes back to 1988, which is not as far back as I want. So let me check the harmonized index of consumer prices. Let's see how far back that goes. 96, that's no good. Okay, let's try PPI. So this is not quite the same. This is the prices producers pay rather than the consumer. But as a proxy, we could potentially use this. So this goes back to 1974 on an annual basis. So let's just use that. Okay, no, it only goes back to 96 according to this. Okay, so what I'll do is I will now, the IMF tends to have very good data on CPI. So I will now use the IMF data. And this goes back to 1955. So we're going to use that now. So this is kind of all the tricks you have to do as a researcher, trying to find data all the time. So generally speaking, the first port of call for data is usually Bloomberg, and which usually gets the data from the national statistical offices from the country. If that fails, I tend to find the IMF data to be very good, because the IMF gets data very far back, and it tends to standardize the data as well, very well. What they call CPI in one country is CPI in another country, whereas countries themselves kind of derive it slightly sort of differently from each other. Okay, so now we have these charts here. So let me just extend the lines. Okay, so now this shows you the real exchange rate. And looks I'm not going far down enough. So now if you look at this chart here, what you see is that the real exchange rate, which is this one here, is kind of very similar, but in the 70s, they diverged from each other. So 70s was a period of very high inflation in the UK and the US, but they had inflation at different points. So what this tells you here is that the nominal exchange rate, the pound looked very expensive over here, but actually in real terms, it was cheaper. So when you start to look at very long time series, it starts to make a difference. Now to calculate PPP, what you have to do is you look at the real exchange rate and you just take an average over whatever sample period you think the currency is in equilibrium. So what I could say is I just take an average over the entire period, and that would be my PPP exchange rate. So it's roughly, so that tells you, okay, so if I just copy paste. So let me just get the right lines together. So let me just get the right colors of the lines here. So the blue line here is the nominal exchange rate, and the orange line is the real exchange rate. And what I've done is I've taken an average of the real exchange rate over a very long period of time. And so when the real exchange rate is below, that means on a PPP basis, the pound is cheap. So right now, the pound is very cheap. It's below the sample average. Whereas over here in 2007, the real exchange rate, the pound was very expensive. Now, as it happens, for the last 20, 30 years, the nominal and real exchange rate moved together. So you could do the same. You could take the average of the nominal and it will come up with the same result. But to do it properly, you have to do the real exchange rate. And so here it was very expensive and here it was very, very cheap. Now, what's interesting about PPP is that it works very well over long periods of time. So I've actually pulled up some data earlier today. Now, this looks at the real exchange rate of the pound going back 200, 300, 400 years. So this is data. This is the real exchange rate. This is from Bank of England. If you go to the Bank of England website, they have this data on their website. And they have data going back a millennia of different series. And they have the currency going back to 1790s. So if you look at the real exchange rate of the pound, going back to say 1820, it follows a range. which is quite remarkable. So the real exchange rate, price adjusted exchange rate, shows you that the pound has just followed, this kind of range. So when the pound's very cheap, over the last 300-400 years, it tends not to get much cheaper. It tends to eventually go back up. And whenever it goes up to this level, it tends to weaken. So this tells you there's some mean reversing properties of real exchange rates, which is what we care about in markets, that we want to get a sense of when is a currency super, super cheap, at which point you want to buy that currency. And PPP is one of the best ways of doing that in FX markets. So in the case of the pound going back to the 1800s, whenever the pound real exchange rate is around the level it is today, it's on only very limited situations has the pound got much weaker than that. Over here, it did. This was the Second World War, and it did here, which I think was ERM, just briefly touched below. But generally, it doesn't get much weaker than where we are today. So that tells you from a valuation perspective, the pound is very interesting right now in order for you to buy the currency. Equally, if it was to ever reach this level, then over the last 200-300 years, the pound has been super expensive, and that's probably the time for you to sell. Now, what's interesting is that you had this period here where the pound, went from this point here to this point here. Like what was going on here? And this is the Industrial Revolution. So the reason why a currency may not move in this way, in this kind of mean reversing way, is if you suddenly have a couple of things that could happen to a country. If one country's productivity suddenly starts to shoot up, i.e. the country can produce much more per person than before, then what happens is the real exchange rate tends to trend up over time. So that means that if you go from here to here, if you would have thought the currency has become a lot more expensive, but if productivity in the UK has gone up, then actually it's not expensive anymore. It's just the fact that productivity has gone up. So it's important to know, is a country's productivity dramatically going up compared to another country or not? Now, with rich countries, productivity tends to be very similar. But when you look at emerging markets and rich countries, that's when you get big differences, because poorer countries, their productivity tends to be much higher than rich countries because they're starting from a lower base. Their growth is just much higher. So if we take China, for example, if I show you another one of my spreadsheets, I put this chart together. So this orange line is the real exchange rate for China. So this is from the BIS, Bank of International Settlements. It's publicly available data. You can get on Bloomberg. You can go to the BIS website. It's all free. They have real exchange rate data for all countries. What they have is something called the real effective exchange rate. Real, as in it's adjusted for inflation. Effective means it's a basket. So this is China against its main trading partners, which in China's case is the US, Euro. So it's like an exchange rate against a basket, exchange rate FX. So I could look at this China versus the dollar, but I just wanted to use China against a basket so that we don't need to worry about the other countries. But this shows you that the China exchange rate has trended up over the last 20, 30 years. So if you looked at this, you would have thought, okay, the real exchange rate is very high, so China is expensive, so you should sell China. But I said earlier, the reason the real exchange rate could trend up over time is if productivity of the country is going up a lot. So if you look at Chinese productivity, so this is China, there's different measures of productivity. Here I'm looking at GDP per capita. That's a simple one. You could also look at GDP per hour and things like that, but I'm looking at GDP per capita to keep it easy. You see that China's productivity has been going up sharply. So, in 2010, GDP per capita in renminbi was around 50,000 renminbi per head, and today it's 70,000. So that's a really big increase. But what you see is that it's been trending up over time. So that means that the trend up in the real exchange rate is justified. So it's not expensive. So what you can do is you can run a regression of the real exchange rate against productivity, and then you can see how far away is the real exchange rate from where it should be based on the productivity trend. So I've kind of superimposed it in a way that's roughly overlaps there. So what you can see is today, the renminbi looks around fair value. If anything, it could be a bit cheap because GDP per capita has gone up. Back in 2015, the renminbi became quite expensive. And since then, it's kind of weakened a bit on a trade-weighted basis. And back in 2005, the renminbi was very cheap. And that was a period where China was starting to generate large current account surpluses as well. And there was lots of complaints around China around that time. So productivity is very important. So the way you would do this properly is that you'd look at the productivity of China, and then you'd look at the productivity of its trade partners and do the ratio of the two. And then you'd see, is China's productivity outpacing its trade partners? If it is, that means the real exchange rate of China should go up. And so you have to make an adjustment for productivity to work out, is China expensive on a real exchange rate basis or not? So is that clear? There's another name for that. It's called the Balassa-Samuelson effect, which we won't go into, but it's kind of talking about something similar as well. Now, the other reason why a real exchange rate could go up is if the country has what's called a terms of trade shock. So terms of trade is export prices of a country divided by import prices. And the relevance here is really for countries that export commodities or import commodities heavily. So for example, if you're Saudi Arabia, a big oil exporter, or Russia, oil exporter, or Australia exports iron ore, if those countries experience a big jump in their commodity prices, so if oil prices go up a lot, then that means that country is experiencing a positive terms of trade shock. That also means then that if that country's real exchange rate is going up, but also terms of trade has improved in that country's favor, then that means that that real exchange rate can stay high. Because although the current currency is expensive on a real basis, on a terms of trade basis, it's benefiting from higher global prices in their main export. So another adjustment people make, especially when you're looking at the PPP of a commodity country, like Brazil, Norway, Saudi, Australia, you make a terms of trade adjustment. And that's also theoretically why often when people do strategy, when they look at, say, Russia, they'll look at Russia against oil prices. And in some ways, what they're looking at there is the terms of trade and the currency. So everything I've described so far is kind of based on PPP as a foundation. You're looking at the price of goods between countries. You're saying iPhone's more expensive in one than the other. That means the currency of the expensive country has to go down to make the prices kind of similar again. Then you can make adjustments. You go from iPhone to CPI to kind of allow you to look at it on a macro basis. Then you make some adjustments if necessary for productivity in terms of trade. And what economists do is they run this in a regression. You just run a simple OLS regression where you have prices, productivity, terms of trade, and the currency, and you run that regression, and then you can work out to see if the currency is expensive or not. So that's one framework for looking at the valuation of a currency. Now, there is another framework that's a bit different, and that's called the macro balance approach to exchange rate determination, or the fundamental equilibrium exchange rate model. The different names for the same thing. This is something the IMF likes to use. Economists love using this because from an economist's perspective, it makes a lot of sense in the head. In practice, I find it tends not to work that well. You can only really use it on occasional basis. I find PPP as a strategist, as an investor, PPP is, for me, the best valuation model to use. In academia, people prefer to use the macro balance approach because it's more sophisticated, but it tends not to work so well for investors. Now, what is the macro balance approach? In essence, it's the idea that a country's external and internal balances should be in equilibrium. What that means is that a country needs to be at a state where its inflation rate is not accelerating. So it's at full employment, at the narrow rate of employment. So that means that the internal economy is stable. And the external balance is at a sustainable level. That means the current account isn't accelerating wider or narrowing in an accelerating basis. And usually the way that's translated in practice for people who use those models is to say that this is all about the current account. So a country like the US at the moment, it has a current account deficit of 2.5 to 2.6, 2.7% as a share of GDP. And the argument is that a country is running a current account deficit, which means that it's importing more than it's exporting. And as a result, if a country does that, it means that it needs to attract lots of capital inflows to balance of payments. So if I just go back to my, where did I have it? I had a spreadsheet with, this spreadsheet here. So this is the iPhone example, but the balance of payments. So balance of payments. So this is the balance of payments. So this is that you have the current account, and then you have the financial account, or you can call it the capital account. All of these things have to sort of balance out in the end. So the current account is basically exports and imports. And this is goods and services. So for a country, goods are simple, cars, toys, those sorts of things. Countries imports, exports, food. Services could be financial services, it could be tourism. And you look at it in terms of inflows into the country. So let's say a country exports 100 units. That means a country is selling lots of cars to other countries. On the services side, international people might be using that country's banks a lot. Or if you get tourists coming into your country, that's classified as an export because foreigners are paying you money, to do something in your country. So that's an inflow you're receiving. And so let's say, and then on the import side, let's say you have 200 imports. So that means you're buying tons of PlayStations or whatever. So that means you have a current account, a current account deficit. So you have a current account deficit here. Now, the way, how do you pay for the current account deficit? That means that you have an outflow that's going to other countries. But the nature of the balance of payments is that if you're seeing an outflow, that means there must be some capital flow that's coming into your country to recycle that current account. So normally the financial account is usually made up of FDI, foreign direct investment. So people buying factories investing in factories in your country. It could be equity inflows, and it could be bond inflows. And it could be like short-term inflows. So that could be somebody, if an international investor puts money in a bank account in your country, that's a short-term inflow. If they buy a bond in your country, then that's a bond inflow. If they buy equities in your country, that means it's an equity inflow. If they buy a factory in your country, that's an FDI inflow. So if we take the US as an example, the US in general imports more than it exports. But normally what happens is that on a net basis, so this was net, this was gross. I mean, this was gross, but I'm going to look at on a net basis. When I say net here, what I'm going to do is I'm going to say that the US does FDI abroad and foreigners do FDI into the US. And if you subtract the two, that's a net number, just to keep it simple. So what I could say is, there could be 20 units there, there could be 100 there, there might be 50 there, and there might be minus 70 there. And then you have the sum of 100, which means it's balanced now. So that means that the country, whenever a country has a current account deficit, it will always, through people's money moving in order to pay for the imports and exports, it will always lead to an offsetting financial account. balance. And the breakdown in this example is that foreigners are investing in portfolio flows and factories, but their money is leaving banks in the country. So you have the financial account, the current account. This is kind of a very rudimentary balance of payments analysis. But the question here is what's sustainable? This is what the macro balance approach says. So, these inflows that the US has got in this example is about 100. But let's say that equity inflow of 100 in normal times, let's say it's more like 20. FDI flows, let's say normal times is 20, which is fine. Bond inflows, let's say normal times it's 30. And let's say short-term outflows, let's say that's more like 100 in normal times. No, actually, let's say that's 70 as well. Actually, let's keep it unchanged. And let's say it's more like minus 50, sorry. And now if we do the sum, so let's say in normal times, these are what the numbers generally look like. Now, suddenly, that means the capital account can only sustain 20 units, which means that the current account deficit is too large. It should really be minus 20 for sustainability purposes, the sustainable level. So the question then is mechanically, how can the current account deficit go down to 20? Because at the moment, in this example, the US is importing too much. It's it's importing 200 versus 100 exports. So how do you reduce imports and increase exports? So you need to do some combination of reducing imports, increasing exports. One way is the relative growth impact. If the US domestically slows down, the US is growing more slowly, the US will import less. If the rest of the world is growing faster, the US will export more. So one adjustment that could happen is relative growth, that you have a growth differential that contracts the current account. The other way is the currency. If the US dollar became weaker, that means that imports become more expensive and exports become cheaper for the US. So a weak dollar means that it's cheaper for the US to export iPhones to other countries. But it's more expensive for Americans to import stuff from other countries because their currency is weaker now. And so what the macro balance approach says is that let's make some assumptions about where relative growth will be in the next few years. How much of a current account adjustment would happen based on that alone. So once you've made that adjustment, you then say to get us from there down to minus 20, in addition to the relative growth adjustment, how much does the currency need to move in order for imports to go down and exports to go up? And you can look at what's called import-export elasticity. So you basically build a regression to look at the relationship between changes in currencies and changes in imports. And you can basically work out to say that, okay, when the dollar falls by 1%, then imports, when the dollar weakens by 1%, then exports go up by 1% and imports go down by 1%. So then you have a 2% current account adjustment. So you can come up with some estimate like that. So what you do then is you say that, okay, once I've worked out how much growth can reduce the current account, I then need to have another, say, 2% adjustment in the current account. How much of a currency move do I need? It may be a 10% currency move is needed that will bring down the current account to the minus 20 that you need. And that's what the macro balance model is. You basically say that what is the sustainable level of the current account? What level of the current account can the US or another country maintain over the long run? How much flows can they normally get in normal times? Then what percentage FX move do I need to bring the current account down? So that's how you map the two to each other. So if I just give you an example then of how I use it in practice. So this is a chart of the US dollar, trade weighted US dollar, the orange line. So first of all, you can see this from 1973. So the US dollar from 1979 to 1985, the dollar went up a lot. Then it fell very sharply around here, down to here. It went kind of sideways for about 4 or 5 years here. Then the dollar went up a lot in 95 to 2000. Then it fell sharply here, went sideways. Then the dollar went back up over the next 5 or 6 years here. So that the orange line is the dollar. Now, the blue line is the current account as a share of GDP in the US. And I've inverted it so that if the blue line is going up, that means the current account deficit in the US is getting bigger, which is bad. So what you can see is that when the dollar reached a peak around here, that was around the time that the US current account deficit really started to grow a lot. So in the early 1980s, what started to happen was the dollar was getting stronger and stronger and stronger. Then suddenly the current account started to get larger and larger and larger. And then there came a point where there was some question marks about the sustainability of the dollar. Can the dollar really get stronger and stronger and stronger? And at the same time, have a deficit that's getting worse and worse and worse, because a strong dollar makes your current account deficit worse because you can't export as much. And so what ended up happening was that, when it reached around 2.5% the deficit, around that point, the dollar really started to fall. Now, the question is, how did you know it was 2.5% of the deficit and not 5% or not 1%? You just don't know. There's no easy way. If you do historical event analysis, it seems to be the case that when you're around 4 or 5% current account deficit, that's usually a point where currencies make an adjustment. In the case of the US, I tend to find that when the US deficit starts to reach around 3%, that's usually a period when the dollar really starts to suffer. In practice, what you need to do is you need to look at the reason why the current account's widening. You also need to look at the capital flows that the US is attracting and try to work out how sustainable do you think those capital flows are. So you kind of supplement it with some capital flow analysis. Now, if you look at the next peak in the dollar, that was around 2000, you see the current account, it went above 3%, it got to around 4%, and then that's when the dollar really cracked and started to fall. And the current account carried on strengthening. Current account deficit carried on getting wider and wider and wider, and the dollar carried on falling until it came to a point around here where the dollar had weakened enough so that the current account deficit started to fall once again. And that actually coincided with the global financial crisis as it happened. So the US had a big recession, had a weaker dollar, and that all together brought the current account deficit back down. Now, in recent years, the current account deficit is starting to grow again. So you can see here, it's not quite at the danger levels, but it's getting there. If you look at the second half of last year, the current account deficit is at 3%. It's around the level where you typically start to see FX markets start to react. So I think we're slowly getting into the danger zone for the US dollar, which is one of the reasons why I think the dollar will probably weaken. So that's the macro balance approach, or the fundamental equilibrium exchange rate approach. But as you can see, it requires a lot more assumptions, because number one, you have to make assumptions about, what is the sustainable level of the current account? Is, in the case of the US, is it -2%? Is it -4%? Is it -5%? Then on top of that, you then need to make some assumptions about the relationship between growth and imports and exports. Then you need to make a forecast about where you think growth will go, to then tell you how much the current account will adjust by. Then you need to make an assumption about the elasticity of the currency to imports and exports. How sensitive are imports and exports to a change in the currency? And then finally, after you've done all of that, you can then back out the currency adjustment that you need. Now, the IMF likes to use this model. Economists like to use these models. Academic economists like to use these models. In practice, though, it's very cumbersome. Now, but I think the intuition behind it, I think, is very appealing. The idea of a sustainable current account is a good framework to use to think about currencies. So I think maybe I'll stop at that point. So the main things here are that although there's this perception that there isn't a valuation framework for currencies, there are. The two main approaches are PPP, based on law of one prices. You can add some bells and whistles, productivity terms of trade, to make it more refined. And then the other kind of school of thought is around the macro balance approach, which is to look at balance of payments dynamics. Current account, what's sustainable? If it's not sustainable, what currency adjustment do you need to bring everything back into equilibrium? So let me take any questions if you have any now.
Bilal, one question. So for UK, if you see current account has been running in deficit much larger, like 3.84%. It's also got other external shocks in terms of Brexit is not really solved. But actually, our house call and generally, our investors on positioning report also turning short long GBP. So is the currency adjustment different in the UK compared to the US? Does it attract more flow or something when this happens? Or
Yeah. No, it's a good question. In the case of the UK, you have a unusual situation, which is that on a PPP basis, the pound is very cheap, as I showed you earlier. But then when you look at the current account dynamics, the currency looks expensive. Because normally what happens is when your currency is very cheap on a PPP basis, your current account improves a lot. Your deficit goes down because your currency is so cheap that you export a lot more and you import a lot less. Now, that's not happening in the UK, which tells you that there's something strange is going on in the UK. And there's really two things that are important to note about the UK current account dynamics. One is there was an impact of the euro crisis on the UK balance of payments dynamics. And what happened was that there was, during the euro area crisis from like 2010 to 2015, as everybody was panicking over the breakup of the eurozone, lots of investors moved from euro area bonds and they started to buy gilts, UK gilts. Now, the way the current account is made up is that, as I mentioned earlier, you have the trading goods and services. So you have, that's in the current account column, but you also have interest payments, interest, profit, and dividends. What you call the income balance comes under the current account. So when a foreigner buys a UK bond, that's a portfolio flow. That's in the capital account or the financial account. But the coupon, the interest that the UK pays on that bond, comes under the income balance that gets paid out from the UK to foreigners as a income outflow, which is in the current account. So the more interest the UK pays out, the worse the UK current account becomes, because that's an income outflow. That comes under the current account column. So one reason why the current account worsened in the UK was that the UK started to pay the rest of the world more interest because people had piled into UK bonds. So that you could say is almost like, is kind of a good reason for the current account deficit to widen, because it reflects the fact that people wanted to buy gilts. But what that also means is when foreigners pull out of gilts, then that income balance will improve and the current account will improve. So that's one side, which you could say, okay, so maybe 0.5% of the current account worsening in the UK is for good reasons. But then the other factor, of course, is Brexit. That because of Brexit, that's led to deterioration in UK trade numbers, both in terms of the UK's imported more as a way of building inventory before a trade shock. So the UK just imported a ton more in preparation for Brexit. And then also UK exports have been hit by companies moving outside of the UK to build things in Europe. So that's kind of a bad reason. So taken together, what that means is that the valuation argument for the UK is less clear cut, because you've had two structural shocks hitting the UK. One positive, euro area crisis, and there's risk premium there. One negative in terms of Brexit. So taking that together, it tells you that the valuation framework gets more complicated. Now, in terms of being bullish on the pound, my view at the moment is much more of a short-term view. My view there is that the UK vaccine rollout is super aggressive, much better than the rest of Europe. The Bank of England said they won't really cut rates, and growth is kind of holding up a bit better than people think. So I think the pound in the short term will do well. Longer term, it's less clear cut, because you have to see how these shocks will unfold. But even though Brexit will hit the UK quite badly, the pandemic is hitting everybody as well. And so that makes the Brexit factor probably less than I would have put before the pandemic.
Thanks. Cool. And in terms of a PPE basis, do you measure against euro as well as dollar just to work out which pairs to?
Yeah, no, that's a good question. I tend to look at everything against the dollar, but then for the European currencies, I tend to look at euro as well, euro crosses as well. So the chart earlier I showed was pound against the US dollar. The pound looks very cheap. If you look at euro sterling, the pound is cheap, but not as cheap. So the euro sterling valuations aren't as compelling, which kind of goes back to perhaps the current account issue.
Thank you.
Sorry, Bilal. Just a quick. Obviously, there's lots of things which factor into whether a currency is overvalued or undervalued. But do you generally see a slow transition towards something being overvalued and then undervalued, and then it gets to a peak and it's a quick adjustment back to the real exchange rate? And generally, is that adjustment quicker in more established currencies than it is in, say, emerging markets? Are they more likely to fluctuate around the real exchange rate? And also, is it impacted by inflation rates getting more equal over time? Are you seeing less divergence from the average real exchange rate because inflation rates aren't diverging so much?
Yeah, no, that's a good question. I mean, in general, I would say that when you have very large deviations from PPP, the snapback is very quick. So if you have like a 30, 40% deviation, it's like an elastic band. Then you see often a very quick adjustment. The challenge, of course, is the timing, of how this comes about. So normally, very quick adjustments usually happen when there's some kind of policy intervention, i.e. a current country suddenly says, look, I want to weaken or strengthen my currency. There's some kind of policy accord. If you look at the chart I showed earlier, back in the 1980s, the dollar went up very and then weakened very sharply. That was 1985, where there was a big, peak and drop. That was roughly around the time of something called the Plaza Accord, where the US, Germany, UK, Japan came together and agreed to bring the dollar down. And around that time, the Fed started to cut rates and the rest of the world started to raise rates. So there was kind of this big policy kind of coordination there. So then you see a very rapid adjustment. So that helps with the timing. So with timing, you tend to need to see a big kind of interest rate move from either side. And then that usually accelerates the decline. So one is, it tends to be very fast if you have a very large deviation. Now, on the other question you had about if inflation is all converging, do you have less deviations? I would say certainly in recent years, we're finding that, over the last like 10, 15 years, you're seeing less acute, deviations. Of course, with the emerging markets, you still see quite large deviations. And so in emerging markets, you do tend to see more of those, misalignments than you are seeing in the developed world. But, I think the other factor in the developed world is the fact that interest rates are also converging as well. And so, what leads to big deviations from PPP, isn't just kind of inflation in itself. You have to think about things in real rates terms. When real interest rates are very different between countries, then that typically leads to big overshoots in currencies. So the fact that inflation's kind of converging to the same level has also meant that interest rates are converging to the same level as well. And then real interest rates then are very similar and you don't get these big deviations. So I hope that's clear.
Yeah, that makes sense. Thank you.
Cool. Okay, Angela, yeah.
I've got a question just on the current account kind of framework for looking at valuations. So does the current account, so is it always the current account that has to adjust, or can the adjustment also take place through the financial account? So how do you balance, especially if you look at the US dollar, like maybe that means that the current account can stay kind of extended for a longer period of time because of the financial account, et cetera.
Yeah. I mean, that's the age-old question, which side should you look at? Because everything balances out in the end. And in practice, the way it's just much easier to model everything through the current account because it's a slower moving variable in some ways. But to do it properly, you need to look at both sides of the equation. The problem on the portfolio, on the financial account side, is that that's kind of linked to financial markets a lot. And so it's very hard to predict these portfolio flows. It's very hard to predict these FDI flows. So that makes it a lot more sort of difficult. But if I kind of give you an example, the dollar really started to strengthen a lot in the second half of the 1990s. And that was a period where the current account deficit started to get bigger and bigger in the US. But at that time, there was huge M&A inflows into the US because of the tech boom, and there was large equity inflows into the US. So that kind of told you that because of this productivity .com miracle, that perhaps the US has kind of was able to reach a new high point in the current account. But then you had the crash in 2000, and yet the current account carried on growing. And then you suddenly realize actually the US portfolio flows, that isn't actually sustainable after all. The whole productivity miracle wasn't there. And then you started to get worried about the current account. And that's when the dollar started to weaken around that time.
But also, I mean, just to add to that, the two sides are related, right? They don't move in isolation. I mean, if you had a situation where suddenly everyone was dumping their US treasuries, that outflow, the US pays that interest on debt. Obviously now it's minimal, but those outflows also stop in terms of debt repayments, and the same is true on FDI because reinvested earnings. So you sort of think of it as like a one-time flow, like a company like buying a foreign entity, but it's not a one-time flow because all the profits then go through the capital account as well.
I mean, they're all kind of interrelated together. There's this book by Michael Pittis he wrote, I think about 10 years ago, on the balance of payments, which I think is probably the best writing on how the balance of payments are all interconnected with each other. That's well worth a read.
Krugman has a good one as well, like on currency crises. And
yeah, we'll send a link to that as well.
But yeah, I mean, the only other thing to add, sort of to Sam's question, I mean, especially in emerging markets, is, I mean, you do tend to see overshooting. Like when a currency goes, it can go a long way beyond what people would term as fair value.